Okay. Today in the Buyers Ought to Know series, a very popular topic that has to do with the heart of contracts for when you eventually buy that house. It's what is a mortgage commitment? So most people know that your standard real estate purchase contract has a mortgage commitment. Some people do not, though. But it's there. Most people say, well, I want to make sure it's contingent on a mortgage. You don't have to. That's usually the default thing. So basically, your standard purchase contracts come with the language for two key contingencies. You can write in others, but those are the two big ones: the home inspection and the mortgage contingency. Home inspection, we're not going to talk about here, but the second one is for a mortgage contingency. So the mortgage contingency by far is the most powerful out in your contract. And basically what it says is if you don't get the loan, then you can exit the transaction without penalty. That means any money that you've put down as a deposit, you get back. Now, there are some very important qualifications here. Okay, first of all, the bank needs to send a letter saying you didn't get the loan, right? So if the bank doesn't send the letter, that's not good enough. You can't just say, oh, the bank's not going to give me the loan. You need paperwork that actually says that most of the time. You need to make sure that you do it within the timeline specified. So if you say you want a mortgage contingency for 28 days, and then you let that expire, and then 31 days into the transaction, you find out you can't get the loan, it's too late. You can't use that mortgage contingency. So those dates and how that mortgage contingency works is very important, and it is very possible to not have the protection even if it was originally in the loan. So you do need to watch this very carefully. Now, it's super important to watch this one because generally buyers have a lot of money tied up in a transaction at this point. It's not uncommon for buyers to have 5% of the house purchase price or more. So on a $600,000 house, that's $30,000. So this money is what I call money in the middle or at risk money. And you really, really obviously need to be conscious of the fact that that money is in the middle. It is no longer in the buyer's possession. And if you don't get the bank loan and you are unable to use that mortgage contingency, then that deposit is at risk. That is a very bad situation. And so you want to make sure that that doesn't happen. So what is actually a mortgage commitment? Well, a mortgage commitment used to be a letter from a bank that says that they will give you a mortgage. It says, here's a commitment. We commit to you that we will lend you money and you will be able to go buy a house. When you get that letter, it typically ends your mortgage contingency. Okay, so once you get the letter, the seller doesn't usually know that you got it, but if you got such a letter, basically you would not be able to extend your mortgage contingency because it had already expired. The contingency is only good until you get the letter. But the banks did sort of a switcheroo around 15 years ago, and they stopped making their commitment letters commitments. They started putting language in there that said, well, we're pretty sure we're going to give you the money, but you need to give us this form and this tax return, and we need to see this, and we're still waiting for the appraiser, and da, 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 da. The longest commitment letter I've ever seen had 4 pages of conditions. So does 4 pages of conditions sound like a commitment? No, it is not a commitment at all. There's nothing really the bank can use any kind of out there at all. So a commitment to lend, a commitment letter says we're going to give you the money, period, full stop, and we'll see you at closing. So, but today the commitment letters are really just a waypoint in the mortgage process where they finally start getting serious about the very last things that they're going to need before they agree to close the loan. Still, though, getting a commitment letter means that you're like 95% of the way through the process today, but you are not all the way. So in response to that, most of the time when you go to your P&S and they revise the mortgage commitment language to say clear to close, or the attorneys will simply continue to extend the mortgage commitment until the bank tells you that you are clear to close. Today, clear to close basically means the same thing as we commit to you to give you the money. So I'm not really sure why the banks changed the process. It worked pretty well before. It's more messy now. It's harder to understand, but today what you're really looking for is the term clear to close from your bank. So now we know what a mortgage commitment is from a bank, and now we know what the mortgage contingency clause is. So now let's talk about whether or not we should waive the mortgage commitment. In a hot real estate market, like now, some buyers get advice that waiving a mortgage commitment is the way to make their offer more competitive. This is true. It will make your offer more competitive, but you are taking generally a lot of risk, right? I mean, it's not going to make your offer more competitive unless you're putting a ton of money in the middle. Okay, if you say, well, I'm only going to put $2,000 down at P&S, well, that's not going to make your offer competitive, right? But if you put a whole lot of money down at P&S at purchase and sale, and then you waive the mortgage commitment and you don't get the loan, all that money is at risk. So basically, the seller is happy that you're going to waive that mortgage commitment because either they're going to get a whole bunch of money and sell their house again, or they're going to sell the house. So for the seller, this works out tremendously. For the buyer, not so much. So even if you have a pre-approval is not a commitment to lend. It is not. They do not have to give you the money. So the money that you put in the middle is at risk and you could lose it. And listen, stuff happens. Okay. There are world events that go on that suddenly change the mortgage market. And if your bank gets cold feet and decides that they are no longer in a situation where they should be lending money, then all of a sudden they just yank your loan. And if you're in between buying a house, you're going to be in real trouble. And sometimes companies call up and they lay a whole bunch of people off. If you're the person that gets laid off, you're not going to be able to qualify for that money. And sometimes this stuff happens without a lot of warning or notice. So you need to be very, very sure of your financeability if you're going to waive the mortgage commitment. I mean, you need to know that you're going to get it. Otherwise, you're going to have thousands and thousands of dollars tied up in that transaction, and the seller's going to have a claim to it. Whether or not they get it all, or whether or not they can take you to court to go get it, and all that kind of stuff is very dependent on the attorneys involved, the amount of money involved, and the way the P&S clause got written. But you don't want any part of this. So, there's only a very small number of situations where you should really be waiving the mortgage commitment. And, obviously one of them is if you're paying cash. But, if you're just trying to get an edge in a competitive bid situation, I would tell you that for most people, that's not what you want to do. Even though the chances that it's going to come back to bite you are very small, it's not worth it. There's other houses out there. There always are, even when the market's crazy. And you can usually get them there are other strategies that you can use to make your offer more competitive that don't involve you putting thousands and thousands of dollars at risk. So be very worried about people who very cavalierly say, no, don't worry about it today. Everyone's crossing out the mortgage commitment. No, they're not. Not everyone is doing that. So I think most people that have been in this business for a long time think that that's a very serious thing to do, and that it should only be done when you are very, very sure about how your finances are going to shake out and you have some sort of contingency plan if the bank's going to yank the loan. So that's really how it all fits together. The mortgage commitment letter, the contingency clause, and whether or not you should waive the commitment. I hope today the buyers out there thinking they should do that, they're rethinking that plan. It's not something to be done lightly. So until next time, we'll see you.